I'm Dan Passarelli of MarketTaker.com here on the floor of the CME Group. So today I was looking at a chart of Boeing, symbol BA. Boeing has been in an uptrend, but over the last 3 days we've seen a little bit of a pullback in the stock. Now that pullback can be a potential buying opportunity. So I started looking at different ways to play this, and obviously there's a number of different bullish plays that I can make, so I have to decide among the different strategies. So what I did is I looked at the implied volatility, because that gives me some indication as to whether options are cheap or expensive and as to whether I should be buying them or selling them. So right now, even with this pullback, implied volatility is reasonably low comparatively. So options are relatively cheap, so I'm looking to do some sort of options buying type strategy. Now, I think there'll be a limited move to the upside. I'm not expecting some sort of huge breakout or anything. I don't think the stock is going to get much above $160 a share. So the best way for me to play this is to buy the Boeing March 155-160 bull call spread, and I can do that for $1.90 or better. Now the reason I like this trade, of course, is because I'm only risking $1.90 on the trade. Worst case scenario, that's all I can lose. But if Boeing does end up getting to $160 a share by March expiration, I can make a significant profit. I can make $3.10 on this. So we're talking leverage, we're talking multiples, return on risk. Now, options right now, again, because implied volatility is low, is pretty cheap. So I'm actually risking less than I arguably should be risking. I'm able to get a really good deal on these options and risk a very, very small amount. I would close this trade before expiration. Either way, if the stock ends up continuing its 3-day route and heading a little bit lower, the market turns around and heads south, I would close this trade and I would only risk maybe about 60 cents. I would close this trade for $1.30 or so if the stock moves a little bit lower. So very, very limited risk. If the stock goes my way, however, yeah, I can make $3.10 best case scenario, but I'm not going to be that greedy. If I can take off the trade and if I can take a profit of maybe, let's say, $2.50, that's still a fantastic return on risk, a great profit potential, and that's where I'm setting my target if the trade works out like I think it will. Now, there's one more thing I'd like to talk about. On June 12th and 13th of this year, Market Taker Mentoring is having its second annual options training retreat. This year, it's going to be in Sonoma Valley, California. It's a beautiful venue and it's an awesome, awesome syllabus that we have planned for you. In this class, we're going to talk about using time spreads to trade earnings. We're going to talk about gamma scalping. We're going to talk about using volume and open interest and unusual activity in your trading. We've got a really great class planned, including a networking reception at the world-class Williamson Winery. So here's what I'd like you to do. If you'd like to learn more about this class and see some of the topics that we'll be covering in this 2-day intensive seminar, go to MarketTaker.com/Sonoma. That's market like stock market, taker like take something, 2 T's in a row, MarketTaker.com/Sonoma, and learn more, and you can register right online when you go to that website. This is Dan Passarelli here on the floor of the CME Group.